Everybody, it is Don and John. I am John. This is Don. Have you guessed that's my 93-year-old father here? And for years, I've been getting a lot of people asking from my students and just other people that are following this strategy that we're going to talk about. They want to hear what we're doing on a regular basis. They want to know the trades we're doing, why we're doing them, what kind of premiums or income we're generating them from them, how we pick our stocks, how we pick our option strike prices, and so forth. So we thought we'd roll this out starting today with the first of which will be a weekly update, kind of what we're seeing, what we're doing, how much we're making, challenges we're facing, and then hopefully answer any questions that you guys may have. This strategy that we use, and my dad Don has been using it for a lot longer than I have. Dad, I think you're coming on 13 years now, if I'm not
Well, it's not
mistaken.
long, but say 10.
Yeah, it's over 10. And he's going to talk to you about how he got into it. But this is a simple option strategy using stocks and then using options on top of that to generate income or cash flow instantly on every single trade you make. And it's a long established strategy. We did not make this up at all. It's well written about. There's all kinds of videos and podcasts about it. But what I found, and my dad did teach this to me several years ago, and what I found is that most of the literature out there, the videos and the books, overcomplicate this, and they don't explain it in a simple methodological way to help people, anyone, figure this out. And that's kind of what I put together, and that's what I teach people. And like I said, it's long established. And I was going to say, I hear so often, and Dad, you can comment on this, and you were guilty of this too, as I was, is that once people hear the word options, they go, "Uh-oh, no way. Too scary, too complicated, too risky. That's like gambling," and so forth. I'm here to tell you, and I think my dad will attest to this, that is absolute hogwash. Yes, there are a lot of exotic option strategies that can get you in a lot of trouble, but we keep it super, super simple. And all we do is one thing: we buy stocks and then we sell options against it. Or we don't buy a stock and then we sell a different type of option, but it's very, very simple. I have students ranging from firefighters to engineers to retired housewives and all in between. So you don't need financial education to do this. And another reason, and by the way, this is for anybody, anyone who, and I think anyone out there listening or watching this wants two things, right? They want to generate cash flow. We all want more cash flow. And number two, we want to build wealth. And that's what this strategy does. And I think another area, and Dad, you can talk about this too, is you look at the statistics of people with a 401k, which has become the primary retirement plan. Get this: the median 401k balance for someone 65 years old is $89,000. The median person at 65 has $89,000 in the 401k. I mean, how long is that going to last for the next 30 years in retirement with maybe a measly Social Security check, which, by the way, Social Security is going to be insolvent in less than 11 years. So using this strategy, you can effectively turn that $89,000 into several $1,000s of income and growth per month. And you really could turn that 80, or let's call it $90,000, into an income stream for life, or a pension for life, as I like to say it. And they're basically, and this episode is going to be a little bit longer than normal. Our goal is to get them to 10 to 15 minutes, but I think given this is the first one, we want to kind of put some context around it, share a little bit more about the strategy itself, and then we're going to get into some of the trades that we've done, that we're in, and that we like. And by the way, let me just make it clear: everything that we're saying here today is not a recommendation. Please, this is not a recommendation. This is just for informational purposes only. Please do not take our recommendations and go out and implement them. And so please do your own homework and your own due diligence. And basically, this is a long-winded opening here, but basically we break it down into what I call the three pillars of investing. First one is fundamental analysis, and that tells you, that helps you identify high probability or high winning stocks. And with technology today, you can do that literally in seconds. The second thing that we do is technical analysis. And that's using a very simple charting strategy that a lot of people, when they hear this, they go, nope, too complicated, no charts. I'm telling you, it is so simple. And yet this is what separates from the pros from the amateurs is a simple chart pattern that you can use to help you see trends, help you identify when to get in a stock, when to get out of a stock, when to stay in a stock. And then the third pillar that we use is cash flow. That's using options to generate that cash flow that we talked about. And in the end, the last thing I'll say before I turn it over is, and I'm going to ask my dad to kind of share how he got into options after being very reluctant of options, is there's two types of options. You have call options and you have put options. That's it. Now, having said that, there are a ton of different combinations that you can use, calls and puts, and they call them spreads and straddles and all kinds of things in between. That's where it gets complicated. And that's where your risk reward can accelerate. But again, we keep it very, very simple. In our example, we don't buy options. We sell options for the premium income. That's where the premium, we sell calls and we sell puts. And we're going to get into that in a little bit. So with that intro, Dad, you want to share a little bit about how you got into options? Maybe your background, in the banking, the Air Force, and then when you retired, you just started. You didn't hire a financial advisor. You picked stocks yourself, and you just bought and held. And then how you got into the option side of it.
Oh, sure, John. I just quickly, my career, I had two of them. First career, I was a fighter pilot in the Air Force, and then I went on flying the reserve for a few years. Also, then I went in the banking business. Ended up running a bank for 20 years before I retired. And yes, as kind of a hobby, I do manage my investments. And I agree. Every time I heard the word options, I thought, "Oh boy, that's gambling." And when I was a fighter pilot at Nellis in Las Vegas, I didn't gamble at all while I was there. So I don't like to gamble. But anyway, the way I got into it, I had a good friend that told me one day. He said, "I've got a few stocks, but I don't have a pension, and I had to increase my income, and I learned to do options." And he said, "I'm making $120,000 a year." Well, I could hardly believe that. But anyway, he said, "Don, you could do that too." So I didn't shoot for 120,000, but I started doing them. And I found that it is rather simple and a lot of fun. It's become a hobby with me. And John, you said something a minute ago that the average 401k is $89,000.
Yeah.
And you can turn even that amount into additional income of some consequence. I just did a quick calculation while you were talking, and I used $90,000. And if you sold calls on that and made just 1.5% a month, that's 18% a year, you could bring a little over $16,000 of additional income every year. If you had 250,000, you could bring in 45,000. Now I'm getting returns that are much higher than that. So I'm using low returns that almost anybody could get. So it is a good strategy.
And Dad, just, and I think those are extremely conservative numbers you're using because as we've talked over the years and other people that I've taught and stuff, I'm shooting for a 2 to 4% rate of return every 2 weeks just on premium alone.
Well, so am I, but I'm trying to say that everybody maybe can't do that or doesn't want to do it, and you don't have to do that much.
Yeah. And I also want to clarify that 2 to 4% in income, or you even said 1.5%. That's just the income side of the ledger. You're still participating, hopefully, in the upside of your stock going up and making profits along the way. So So anyway, I typically won't even take on a trade unless I can get a 2 to 4% return on cash flow every 2 to 3 weeks. Otherwise, it's just frankly, it's not worth my time. And I also want to clarify before I forget. This is not day trading. I don't have time for day trading. I'm sure whoever's watching this doesn't either. And I know too many day traders that you know, I see them and they look like zombies staring at screens all day.
And
I
I don't
certainly don't
think
want to.
many of them make very much money, to be truthful.
No, not at all. In fact, so that's what it's really about, and that's what we're going to be talking about over the next, going forward. Hopefully every Friday, and kind of sharing with you our strategies, and then answering any questions you have. And I've got some questions that have come in that we can address as well. But Dad, you want to kick it off with maybe a stock that you're looking at, or maybe you're out of now,
Um,
but you did well on, or maybe
well,
you even struggle. We're going to talk about our losers too, because it's not all winners.
I've had a few of those. By
Yeah,
the way,
yeah.
you said something earlier. An author I follow told one of his books said the selling calls is so conservative he has his mother doing it.
Yeah, exactly. No
And
joke.
he said she's making quite a few bucks, but I think you're foolish if you don't add value and cash flow to the stocks or the investments you have. Well, anyway, I just happened to pick one up here that I did. Let's see, a couple days ago actually. A cosmetic company that I like very much. I don't use cosmetics, but the ladies sure do. And, it's Elf Beauty,
What's
ELF.
this? The symbol is ELF.
Right, right.
Okay. Yeah.
And I have owned 200 shares, and I it's a high volatility stock, and it's been trending up. And so, on a high volatility stock, you can generally get better premiums, and you don't have to go out as far. So, on that kind of a stock, I like to stay within a couple of weeks if I can. So, I went out 15 days, and I went way out of the money, $16. So I wouldn't get assigned, and made $940 for
Wow.
2 weeks, and that's a 3.1% return.
So sorry, you bought 200 shares?
I already own 200, and I
Okay.
sold a
So
call.
just so everyone knows, in the options market, you must own 100 shares of a stock that you like. That equals one option contract. You can't do this with 50 shares. It's in increments of 100. So for every 100 shares that you own, you can sell one call option against it. And
Right, so
so
I own 200, that's why I did two contracts.
right. And so what did you set your strike price?
Well, the stock price at the time I did it was $154.63.
Uh-huh.
And I set my strike, as I said, way out of the money at $170.
Wow. So folks, just so everyone understands, he sold a contract against his shares of stock, or in this case, two contracts, and he set his strike price at 170 for 2 weeks. And he can determine what that strike price is. He can determine what the expiration date is. They all options expire on Friday. He could have set it for a year if he wanted to, if not longer. Most of us, we keep our contracts in the 2 to 4 week range. Expiration gives us a little bit more control. And so he bought it. He bought the stock at 154. He set the strike at 170. So anywhere from now until that stock hits 170, excuse me, let me repeat that. If that stock hits 170 or above, that stock can be taken away from him from now until expiration date. At that point, typically 99.9% of options, even if that stock goes way over your strike, is going to it's going to be exercised or assigned, or in other words, taken away from you at the close of business on that Friday of expiration. So if that stock goes above 170 at expiration, that stock will be taken away from him and he will no longer own that stock. But in this case, he made $900 on the premium immediately.
I'll make
Excuse
about
me.
3,200 capital gain on top of that if I'm assigned.
Correct. And then the profit of $3,200. So it's a win-win. If he doesn't get assigned, if that stock doesn't hit 170, that option contract expires useless. He still owns his stock. He still keeps his $900. And then he could either, if he still likes the stock, he can hold on to it and sell another covered call out into the future for more premium income. And you can just keep doing this over. And that's a lot of times we do that. It's just over and we just keep rolling them over and over and over again.
That's what
So
I
anyway,
do all the time.
so Dad, why, starting with the first pillar, fundamental analysis, why did you like ELF in the first place? And what do you use to help find ELF?
Well, I came upon it on a website that I have, VAR charts, and I saw that they were listing it as a possible stock to buy, and so I looked at it, studied it, researched it, and looked at the stock chart. And you don't have to be a rocket scientist to when you go in the store and you see all the cosmetics that are for sale. That I've always felt that the cosmetic business is a good business, and
Yep.
so I like the industry, and I like the stock, and I like the uptrending chart. So I bought the stock and then sold the call, 2 contracts.
Excellent. And so, wait, where are you now in this?
Well, I'm just a couple days into the contract.
Okay. So it expires in 2 weeks. It's only at 157. So you're still far away from getting assigned on that.
Oh yeah, yeah,
Oh, that's great. That's on my watch list. I need to take a look at ELF.
yeah, yeah. Well, I've been in some other cosmetic companies, and I made some money on Ultra and Estee Lauder, but for reasons I prefer this one right now.
Yeah, I did well on Estee Lauder, but I stayed away from Ulta because I think I got too rich.
Yeah, me too. Yeah, but I
But
didn't. You know,
and here I'm going to share my screen. This is the technical part of what we do. And at first glance, you're going to say, "Wow, that's a little too much for me. I don't think I can deal with this." But I'm telling you, we use, well, right now it's showing, it's showing 4 different chart indicators, technical indicators that we use. This top one, and this is the stock going back 6 months. We use 6 months in our technical analysis. This band around the stock price is called the Bollinger Band. And this is a new technical indicator that we're using, and we really like it. And if you study this a little bit, it doesn't take that long. It can really help you determine, because stocks move in trends, and you can really kind of get a feel for the trend or the direction that stock is headed in. So this is Bollinger Bands. These two are called the MACD, moving average divergence and convergence. You don't need to memorize that. We just call it the MACD. And in fact, Dad, I don't even think you use this one anymore. I think you're just using the histogram, right?
I just used a histogram.
Yeah. So again, these are the same, and I'll probably get rid of this one as well, because the histogram is a much more visually friendly way to kind of see the trends. And just compare this. You can see here's the stocks dropping, and here, sure enough, the stock is dropping. Stocks coming back, dropping, and you just follow along with what that stock is doing. This is the RSI, which is the relative strength index, kind of tells you where it's priced. And when this index hits 70, that typically means it's overpriced. And when this index hits 30, typically means it's oversold or underpriced. It's that simple, folks. And you can kind of track it right along with the stock above. And then this is OBV. I think, Dad, you use a little different version of this. This is on balance volume. This is an accumulative volume measurement of tons of volume going in and tons of volume going out. So when you see high volume, that typically means people are buying it. And that's a very bullish or positive trend for the stock. And when you see volume falling, that means people don't want the stock, and you'll see that in the stock price. So that's it, folks. That's the technical analysis. And again, this is what differentiates the pros from the amateurs. And it's not hard. And Dad, I don't know if you agree with me, but you use this for a couple of weeks, and pretty soon these charts, they start to talk to you. And
yes, they do. You have to spend a little time on them.
yeah,
And see, I want to
yeah,
go back to the fundamental part of it and just say something quickly.
yeah,
Um, in our investment club, we're trying to teach everybody how to do fundamental analysis. And the best way I think to do it without paying for expensive programs and so forth, like Value Line and other things, is you can get all of the information on Yahoo that you want
yeah,
uh, to do a fundamental analysis. You can see what the analysts think, what the stock targets are, what the PEs are, all of that's on Yahoo, and it's free.
yeah. In fact,
So I
I'm gonna
highly recommend.
I'm looking at it right now. Um, is my screen still sharing? Do you see my Yahoo right there?
Yeah, I'm moving it so you can open it up there. No,
Oh,
no, you're out of it now. There you
okay,
are.
there we go. Yeah. So this is Elf. That's the stock we were just talking about. I use this all the time, and it's free, like you said. Here's a great snapshot here, and then I get, here's the latest news, which I often look at. I look at all the time.
I do
But
too.
right, because this is the latest, this is sort of the latest things that are happening. Um, Not in
Now,
real time, but
well, just
yeah.
for example, there's Zacks, and if you subscribe to them, it's quite expensive, but you get their recommendations right there by opening that up and reading the article, and it doesn't cost you anything.
Yep. 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 The other thing I like about this is that when you go in here, and let's say you're following Elf, and you'll see some of these articles, and you'll find other stocks. Like, for example, here's Investor Place 7 days ago. 3 stellar stocks poised for a multi-year blast off. Well, we know one of those stocks is going to be Elf because we're on the Elf page. But now I may learn of 2 other stocks. Here's Nvidia,
Good point.
and then here is I know this stock, Palo Alto, of course,
I just bought
PAW.
that. I just bought Palo Alto Networks.
That's, well, there you go. So it's a great way to actually speed up your fundamental analysis without having to roll. And we don't do this anyway, but you can find other great stocks that are associated with the stock that you're following. And then on Yahoo Finance, quick snapshot of revenue and earnings. And then I always look at this down. Where am I? Here are the analysts that cover it. 14 analysts are covering it. 4 give it a strong buy, 3 give it a buy, and the rest give it a hold. And then they kind of tell you what the average analyst, if you average out all the analyst price targets, right now it's at 161. Someone thinks it's going to someone thinks it's going to 190. Someone thinks it's going as low as 125. It's currently at 157. So according to the analysts, it's roughly $4 underpriced. So that gives me a little bit more assurance and comfort that I'm buying a stock below consensus estimates. So anything else to add to that, Dad? I mean,
No, that's right. But if you go to the top, you can see the other,
yeah,
or you can get a chart you see up there, and you
yep,
can put all the things on that chart that John showed you, or less, whatever you want.
yep.
Statistics, profile. You can read about what the
Oh,
company does, and then analysts. We just looked at that, and
yep,
there's the option chain too. Although I don't use that one for options, but
yep, yep, yep. So that's Elf. I can do the next one. I think we're gonna do 4 today. 2 each. And my selection is Google. And let me just pull up Google on Facebook, excuse me, on Yahoo. And based on my fundamental analysis, I like Google. Um, I don't personally like the company, but I like the stock, and I like the trend that it was headed in. All the news was very positive. If I looked at the analysts' estimates, earnings are strong, revenue growth is very strong, and right now. Well, I bought it around 142. Right now, it's over the analyst consensus, um, and the analysts are still maintaining their ratings on it. And then I did pick up another stock in here from Google. I can't remember what it was, but I bought 200 shares of Google at roughly it was 142. And I'm just looking at my strike price. Yeah, so here's a good example. Um, and I did what we call a strangle, and it sounds awful. It sounds dangerous, but and I don't think we should get into puts today. But basically, what I did was I bought 100 shares at 142. Oh no, wait, no, excuse me. I bought 100 shares at 138, and then I sold a call at 145 for 2 weeks. And as we now see, that stock is at 153. And this option contract expired today. So my strike price was 145. The stock's at 153. So I got taken out at 145, even though it's at 143 today. So this is a good conversation because, Dad, you and I have different opinions on this. So I get taken out at 145. The stock's at 153. So there's an $8, almost $9, what they call missed opportunity that I missed out on. I still made money from what did I say it was? 138 to 145. So that's a $700 gain, or in this case, $1,400 gain because I own 200 shares. And then my premium income was, what was it? Excuse me. It's not coming up. My premium income was about $400. And so I'll take that all day long. Yes, I did get called out early. Yes, I did miss out on this run up. But my argument is Google's at 153 at this moment. It's a snapshot in time. On Monday, that stock would I have sold it today? No. Monday, that stock could be back down. I don't know. But to beat yourself up when I made income, I made profits. I don't agree with that. Even if that stock just took off and went to the moon. And I've got another example. I can share it another time on that. But a lot of people don't like that, and they feel like they missed out. And like Dad, you don't like that.
Well, I look at it two ways. A lot of times, if it weren't for the option, the premium income, I wouldn't have bought the stock in the first place.
Yeah.
So if I made $1,000, let's say on the premium, but I could have gotten $500 more on the capital gain because I got assigned. People say, well, you were foolish for doing the option. But on the other hand, I would argue, well, I wouldn't have bought the stock in the first place. So I wouldn't have made anything.
That's a good point.
So you can look at it several ways.
Yeah, that's a very good point. And by the way, important to note, both my dad and I, we have a significant portfolio of just buy and hold stocks, high quality stocks, pay dividends. Dad, you have a significant portion in bonds. This is a smaller percentage of our portfolio that we do options in. Is that
Right. That's
okay? Good.
exactly right.
Yeah. Okay. And by no means will we ever recommend that you take 100% of your investment portfolio and you use this strategy. I think it's really important to have a safety portfolio that's just more of a buy and hold. So I want to make that clear. Now, okay. So now that I'm out of Google, I'm going to check the charts, and I'm going to, lean on the charts. As I always say, check the charts, lean on the charts to help me decide what direction to go. Do I want to get back into Google at 153, almost 154? Or do I want to sit it out until Google comes back down a little bit and then do that strategy? Or do I just want to move on to a different stock? The other thing that I could be doing, and I don't want to get into, it's probably too early to get into this right now. Instead of buying the stock, I would just sell a cash covered put at a lower price, and then I'd generate instant income. So that's probably another thing that I would be seriously considering. Dad, what do you got another stock you want to mention?
Well, just as a conceptual thing again, I have a lot of stocks that are quite conservative. For example, Home Depot, I think is a great retailer. I think it's a relatively conservative stock. And so in that case, I'll go out 4 weeks and not pick up much premium, not get much of a return. But if I like the stock, why not pick up an extra couple $300 and sell a call? So that's what I did recently with Home Depot, and I went $14 out of the money, and I only made $260 on it. But that adds to the dividend that Home Depot pays, and increases my cash flow. So
it's free money.
On some of those conservative stocks, I'll go out a little longer, and I'll accept a lower premium.
Yeah, I think that's why our good buddy John, won't use his last name, but he and I've had several, they say this is like printing cash. And the example that I've heard before is if you owned a rental property, let's say you bought an apartment, not to live in, as a rental, as a investment property, excuse me. Would you just let it sit vacant, or would you put somebody in there for rental income? No, of course, you would put a tenant in there for the income. And that's kind of what we're doing here. It's not rental income that we're buying. It's not a rental investment property that we're buying. We're buying a stock, and then we're using that to generate our rent income. I think that's a pretty good analogy. And again, that's why people say this strategy is like printing cash. And it's just sad that more people, I would guess, if I had to guess, this well-proven strategy that, I talk to the experts at Schwab, and they will all say this is the best strategy that you should be using. And yet 99% of people have no idea it exists. But anyway, so did you want to add to that, Dad, or talk about another stock? Or you mentioned Home Depot?
Yeah, well, I did mention, of course, Home Depot is a conservative stock, and I have other options like that where I get lower premiums, and they're dividend-paying stocks, so the few dollars I get in premiums just increase the cash flow that I'm getting in the stock. Sometimes I'll go in between, and maybe just 3 weeks out. I just did one on a company I like, a microchip technology, and I own 300 shares there, so I did 3 contracts. I went $5 out of the money. I got $1.70 or $510, and so that's a nice little return for 3 weeks, $510.
That's phenomenal. Yeah. The last stock I'll share is, and I'm trying to get I should have gotten this in advance. I'm trying to get my premium information. But it's a company called Morphosis. And Dad, you turned me on to this.
Oh, yeah.
Symbol MOR. And while we bring it, do you want to just share how you came up with this? I'll look for how much my income was on this.
Well, This is, frankly, this is the kind of stock I wouldn't recommend to your clients, your students. I thought this was a fun, risky thing to get into. And what I did was pick two of these stocks with the highest implied volatility, and that's a whole different subject. The higher the implied volatility, the more volatile a stock is, and the higher the premiums are going to be. And so I picked two of them with very, very high implied volatility, and MOR was one of them. And I just took a chance to have some fun, and so and I did one other one, and the other one was a German company that had had the highest IV in the whole market, and I made in 3 months $10,000.
Jeez.
But here's going back to being assigned, but I was assigned because Johnson and Johnson agreed to buy the stock out, and the stock doubled in one day.
That's right.
And so I left $14,000 on the table, but I made 10. But going back to what I said earlier, if it hadn't been for the premium, I wouldn't wouldn't bought the stock in the first place and done the option. So I was pleased to make $10,000. Otherwise, I wouldn't have made it at all, even though I left 14 on the table. And MOR, I've forgotten what my option was, but I made pretty good premium on that one as well. And that's still outstanding.
Yeah. So for me, I didn't, I just kind of relied on I took a gamble on this, relied on your fundamental analysis, and went in with, it's only, by the way, it was only $9 or $8.50 a share. So, and I wanted to share this example is because you got to own 100 shares, as I said. So, a $10 company, $100 a share, that's $1,000. So my point is that you don't necessarily need the big bucks to make money on this strategy with high price stocks. Here's a perfect example of a company that was trading for me. I can't get my lot details. I apologize. I'll get these for the next call. But from memory, it was in the high eights, $8 a share when I bought 2,000 shares, and I sold calls on it. They expired. So I still own the stock. And now the stock's at 1165. So I'm up $4,000. And on Monday, I'm going to sell 20 contracts for premium. And then we'll see what happens. So hopefully, actually in this case, I don't know. Stock's at 1162. It's a biotech stock, which I typically stay away from. It might be a little pricey right now. I possibly could just sell it right now and just take my profits. I've made good premium income. I'm up $4,100 right now. Maybe it's time to just take my profits and watch this for a while. I don't know. What do you think, Dad?
Yeah, I really don't know at this point, but I would think it's a little bit overbought right now, but I'll have to see. But these are the fun things, John, that people could get into later on.
Yep.
I wouldn't recommend your students just starting out doing things like this.
Oh,
But
gosh, absolutely not.
these are the things you can do that are a lot of fun. And you can make a lot of money, but they're a little more risky.
Mm-hmm. Absolutely. Absolutely. Well, I think that wraps up a good one for a beginning recap of what we're doing. Any last final thoughts, Dad, or are you just ready to wrap it up and call it a weekend?
No, I think we've covered everything. But again, this is something I think you're foolish not to try this, frankly.
Yeah. Yeah. And look, 93 years old and he's still at it. And Dad, just to confirm, because I say this a lot, people have heard me say this, probably a lot of people say that's BS. You're generating 15 to 20K a month, and you've been doing that for the past 10 plus, I think it's 13 years. Can you just confirm with everybody that that's a fact?
Yeah, yeah, yeah. this year was particularly good. I made quite a bit of money this past year.
Yeah, there's months
But
this year
you don't have to set your sights that high.
no. And I saw your spreadsheet for last year. There was months that you were in excess of $20,000 per
Yeah.
month. But again, that's important that you say that the people shouldn't set their expectations anywhere near that high, especially in the beginning. And also, I tell everybody that if you're going to do this, you should practice trade first for several weeks, if not a couple months, before you put any real money into it. Um,
Boy,
you can
that's a
do it on a
good point.
yeah, you can do it on a spreadsheet on a piece of paper. Just track your stocks and your options, and
They call
what
it
will
paper
happen is you
trading.
what's
Paper
that?
trading. They
Paper
call
trading.
it paper trading.
Yeah, exactly.
That's a great
And
idea.
yeah, and you'll kind of develop an intuition when you do that, and you get more confident in the decisions that you're making. But we'll talk more about that in future episodes. Let's see what else I was going to say. I guess that's it. Oh, if you want to learn more about this strategy, I do have I think a 38-minute masterclass on my website, and it kind of runs through all of this stuff. I show you exactly what we do. And you can go to my website and it'll be in the show notes. John MacGregor, and it's MAC, johnmacgregor.net/masterclass. Or if you want to learn about the program I teach, johnmacgregor.net/cashflow. Leave a comment, ask a question. We'll make sure we address it next week. And with that, have a wonderful weekend, and we'll see you next week.
Thanks, folks. Enjoyed it.
Take care. Bye-bye.
Bye.